Singapore will see its first SPAC listings this week. VTAC and Pegasus Asia will be making their debuts on the SGX. SPACs, or special purpose acquisition companies, can offer a faster way for private firms to go public than the traditional route. And they've taken the US market by storm, and now Asian bourses are racing to attract SPAC listings too. But as Eugenia Lim reports, investing in this asset class hasn't always proven to be profitable.
Blank check companies, or SPACs, have seen a phenomenal rise. Over 600 listed on the US markets last year, raising a record $162 billion. That's almost double the proceeds raised in 2020. But with many SPAC deals floundering, and as the US regulator mulls tougher rules to keep the market in check, those numbers may not continue. Increasingly, US SPACs are casting their nets wider in their search for potential target companies.
Quite a number of US SPACs companies coming to Asia to source for these SPAC targets. In fact, actually, there are some SPACs companies that are listed in US. In the prospectus, they actually mentioned that they are actually looking for growth companies in Asia to acquire. Very simple, because Asian population is growing, and there are actually untapped opportunities.
Exchanges in Asia want to get in on the action. Singapore's SGX introduced its own SPAC listing framework in September last year, while Hong Kong adopted new rules on the 1st of January. Bursa Malaysia has updated its guidelines to draw SPAC listings on its exchange as well. Recognizing the growth potential in the APAC region, Pegasus Asia hopes to get first dibs on potential target companies. It wants to move as quickly as possible to take advantage of its position as one of the first movers.
I think there are many good opportunities for high-growth tech companies in the Southeast Asia and broader Asia-Pacific region. So, as far as we are concerned, the market can handle even more than the 3 SPACs that are coming to the first round.
As for retail investors, timing is key. The D-SPAC index, which is a group of 25 companies in the US that went public by merging with a SPAC, is down about 40% in the past year. So investors who get in early and subscribe to the SPAC IPO stand to gain the most.
These are virtually free lunch. It's an arbitrage because your $5 is backed by cash, and you're given free warrants. Who doesn't want a freebie? But if you are not lucky enough to get these IPO shares, if you are coming in at post-SPAC, you just have to be wary. There's a lot of unknowns, valuations, target, shareholding spread of the target company. And therefore, at most, you just pay just a slight premium and not be too carried away with the hype over a potential target company.
Excessive hype over target companies has muddied the US SPAC market. But here in Asia, a new crop of private companies, often in digital, fintech or biotech sectors, await the opportunity to go public through this route.